Mr. Joseph Lucking. He is a member of the Commodities and Logistics Group at Brown Brothers Harriman and Company, where he works as a team with a team of investment professionals responsible for providing debt and equity capital and strategic advice to suppliers, traders, merchants, processors, distributors, and logistics providers operating in the agricultural commodities. Please welcome to the stage Mr. Lucking.
Good morning, everyone. I'm excited to be here today amongst friends, clients, and other industry leaders. For those of you who I have not had the pleasure of meeting yet, my name is Joe Lucking. And for those of you not familiar with Brown Brothers Harriman, we are the largest, or one of the largest and the oldest partnerships structured in banks in the U.S., established in 1818, and we have been very active in the commodities finance space, particularly coffee, since 1857. Without further ado, the question everyone has been asking for what feels like years, because it has been years, is what are the chances and the probability of recession in the next year? So as I mentioned, I fancy myself a commodities finance professional. I'm not an economist by trade, but to me, seeing 55%, it's highly unsatisfying. You know, what does that really mean? But I think what this underpins, and if we're going to take a top-down approach here, is that there's evidence on both sides of the economic equation. So if I wanted to put together a presentation filled with data points about how strong and robust and durable the U.S. economy is today, I could totally do that. Very good. On the other hand, if I wanted to prepare a presentation outlining how awful the economy was and is, and how we were heading towards a recession imminently, I would also have the data points to prove that point. So today, I think we're living through the tail end of the pandemic and the economic policy responses to it. And you know, it strikes me that airports are full, we're back at restaurants, everyone's traveling, as evidenced by the fact we're all here today together. And I think the behavior implications are done, but there's still lingering side effects. So to start with evidence as to why a recession is imminent and perhaps already upon us, let's look at what is aptly named the leading index of economic indicators. The blue line is the index, and the red line indicates year-over-year change, with the shaded areas pointing to past recessions. So you'll see the index has been negative for over a year, and every time this has happened in the past, there's been a recession. So why should this time be any different? You know, financial markets are also demonstrating very similar dynamics. It's a lot of volatility day to day. Another data point as to why a recession might be imminent or already upon us. The inversion of the yield curve, which is the 10-year minus the 2-year treasury in this particular case, has been a very good indicator of an economic downturn. And what I mean is that short-term interest rates are higher than long-term. So the slope is downward rather than upward, which is the normal case. So signs from the fundamental economic data set that we should be in recession or close to it, signs from financial markets that we should be in recession or very close to it are all there. It just seems the economy itself has not received the memo. So what you're looking at here is quarterly GDP growth dating back several years. That's real GDP adjusted for inflation. On the very left-hand side of the chart, you'll see, you know, coming out of the pandemic, the extraordinarily high GDP growth that was experienced. And then the year ending, the quarter ending September 30, call it, you see, you know, bounced around between 2 and 3%. Now looking at September 30, it's an extraordinary growth story, 4.9% GDP growth in September. So even more astonishingly, you're beginning to see a conundrum I'm faced with. How can this possibly be? So we have all of these headwinds and macroeconomic data telling us that recession's imminent, but also a lot of tailwinds, and as evidenced by the latest print, robust growth. So I think what's this telling us is the economy has been durable, and not surprisingly, I think there are three real key factors, personal consumption being the primary driver of all economic activity. So the first of the three themes that I will examine is total labor force. So what we're seeing right now is a greater than expected recovery in the absolute size of the labor force. We typically think of labor statistics being about unemployment rates, things of that nature. What we're looking at here is simply the size of the labor force in absolute terms, the number of people working in the United States. You can see here on the left-hand side again, after the global financial crisis, the downturn, and then the pandemic, really leaps off the page. It's interesting that not only has the labor market recovered all of the jobs lost that were put on pause during the pandemic, but we're actually 4.5 million jobs higher than we were in February of 2020, which is the last full month before the pandemic really hit in force in the United States. Even more remarkable, it seems increasingly likely that not only will the labor market recover the previous pace of growth, but also the previous level in terms of absolute jobs. That's very unusual. So if you look at the dotted lines, they sort of represent the pace of growth. You can see the first dotted line on the left, that after the global financial crisis, the market reestablished the prior pace of growth, but there's a gap between those two dotted lines. So in other words, what that points to is there was a permanent price to be paid in terms of lost jobs. The difference between those two dotted lines is roughly 10 to 50 million jobs. But it looks increasingly likely, if you look at the slope of the blue line in recent periods, that the absolute size of the labor force will actually close the gap, which is pretty remarkable. Continuing on the topic of labor supply and demand, part of the reason this is happening is there's a real imbalance. Here too, the lines represent the number of jobs. These are not percentages of anything. The gap between these two lines represents that as of the quarter ending September 30, that's the latest data available, there were 3.3 million more job openings than there were people available to fill those jobs. So no wonder there's a high level of job security. No wonder wages have been growing at a sustainable pace. All this feeds more money into the pockets of American households, more confidence, more psychological willingness to spend money, and therefore a real tailwind to economic activity. But at the risk of raining on the parade, I'll note that the gap between the red line and the blue line 1 year ago was closer to 7 million jobs. In other words, this gap has been narrowing. And as this gap continues to narrow, I believe we'll see a tighter labor market. Jobs will not be as plentiful. Some of this job-securing confidence will begin to dissipate. We'll watch what unfolds under the course of the coming year, because what has been a tailwind, that is the strength of the labor market, may at some point wane or even turn into a headwind as the year unfolds. A second driver of economic growth is the surprising strength of the housing market. The blue line represents the median U.S. home price, and the red line represents year-over-year change. While geographically diverse in terms of this is the resilience of housing prices and home values, home values across the U.S. have remained resilient and are roughly flat, up 0.1% year over year. This is one of the things that just should not be. And it should not be because of the rapid rise in mortgage rates. If 1.5 to 2 years ago, I had a perfect crystal ball that was always accurate, and you were to tell me that the Federal Reserve would rise interest rates to the point where a 30-year fixed-rate mortgage would go from 3% to 8% in the span of 18 months, I would have assumed the housing market would have cratered. And yet, as you saw on the last slide, it did not. This thing is different, and the difference is for the precise reason that although the prevailing mortgage rate in the US is close to 8%, so if you were to go out today and finance a new home or refinance an existing mortgage, that's what it would cost you. But that's not true for the vast majority of homeowners. If you were smart enough, or perhaps lucky enough, to have refinanced your mortgage 3 to 4 years ago, near a low point on this graph, congratulations. You now have a 26 or 27-year mortgage and are paying something like 3%, 3.5%, if not lower. So if you average that across the entire economy, the effective mortgage rate, what people are actually paying, is less than half of the prevailing mortgage rate. That's the blue line. That's remarkable. And what it says is the effects of rising interest rates have not actually hit the housing market, at least not fully, because it hasn't hit mortgage payers. It's a curious side effect, and that curious side effect is as follows. If you were one of the people who locked in mortgages at 3%, the very fact that you have a cheap source of funds is an obstacle to selling your house, an obstacle to the desire to sell your house, that is. You may very well want to move, upgrade, change homes to another part of town, or sell your home altogether. But to do so would mean you're paying the red line, not the blue line. The implication of this is somewhat ironically that higher interest rates have dented not only the demand for housing, but also the supply. All else being equal, if demand does go down, then so does the price. But all else is not equal in this environment. In terms of housing supply, the blue line on this page represents existing homes for sale, while the red line on this page is new housing starts. Clearly, a lot of volatility and variability is in this data, but if you add it together, what we find is that the supply of housing in the US is at a 25-year low. And of course, population continues to grow. So there's a line that's drawn effectively under the housing market simply because of depressed supply. But as with the labor market, I do not think this will last forever. Let's jump back to slide 9. So you see there's been a slight uptick in the effective rate on outstanding mortgages. It's almost like an economic law of gravity, in that the red line, which is market-driven and has a good deal of volatility, does, in fact, influence the blue line as people refinance, as mortgages mature and are repaid, as people move, et cetera. And I do believe the blue line, that is the effective rate people are paying on an outstanding mortgage, will converge with that red line. That's a process, not an event. It will be slow, but as it does, that too should take some of the wind, or relative wind, out of the sails of the housing market. And of course, so the job market's one tailwind, housing market's another, and the third tailwind is what has been very well covered, and that's the dynamic of inflation. What you're looking at is the consumer price index year over year. It's broken down as it has two components, the core component, which is in blue, and the food and energy component in red. I do that for two reasons. One, I'm not that clever. That's the way the US Federal Reserve does it. Core inflation is what really drives policy. And two, I also do this because the red part is really the part people experience firsthand. Economists experience inflation through spreadsheets and data, which is abnormal. Most people experience inflation at the grocery store, at the gas pump. That's the red part of the graph. You can see in the past 7 months, the red bars point down. There's been year-over-year deflation in the commodities part of the basket, largely food and energy. This is important because it has a big impact on people's well-being and their feelings of well-being. And this is one of my favorite indices, the Misery Index. It's a somewhat tongue-in-cheek name, but it does an excellent job, I think, at demonstrating some of the dynamics we've been talking about. It's the simplest of all possible calculations. Inflation, CPI, plus the unemployment rate. After all, that's, as we've discussed, where economics strikes the home for most people. Right now, the sum of those two things is 7.5. Not necessarily units of anything, again, it's just adding those two data series together. And if you look back over a long-term period, that's 75 years of data on this chart, the blue dotted line, or average by decade, is, you know, compared to where we are now, we're pretty low relative to the past measure of inflation and unemployment. So, again, if my presentation were to stop here, not so bad, right? But almost by definition, economics is a backward-looking science, and data is already in the books. So if you allow me, I'll peek around the corner and examine a couple things that may confront us, and there are some storm clouds gathering on the horizon. First, in the US, the federal government shut down. So a few weeks ago, US Congress agreed to a literal last-minute deal to fund the government through November 17th. In the near term, this poses minimal sentimental risk simply because it's happened before. It falls into that category of unknown unknowns. Indeed, if you look at the history of government shutdowns that go back to the presidency of Gerald Ford, they tend to happen around the end of fiscal years, last a few days, and there really isn't a measurable market reaction, nor is there an economic reaction either. People end up getting paid, even if delayed. It's really only disruptive if you're a US citizen trying to renew your passport or visit a national park or something like that. But the macroeconomic implications historically have been relatively muted, is the point. But relatedly, what I'm a little more concerned about over the longer term is the implications of US debt ratings. So the color-coded chart looks at the ratings of the US debt from three big rating agencies, S&P, Moody's, and Fitch. Coming out of the global financial crisis, all three had AAA and stable outlook, which is the highest of credit ratings for the United States. There was a protracted and prolonged debt ceiling debate in 2021, which prompted S&P to lower the credit rating to AA+, which was the first time that the ratings outlook had been cut in the history of the United States. Moody's and Fitch at the same time put the US on negative outlook, which is kind of a warning shot, but both restored to AAA thereafter. Then, earlier this year, Fitch actually downgraded the US to AA+, which was a little bit out of the blue, but I highlight in the circled excerpt really outlining their rationale for this decision. And that's effectively that steady deterioration in the standards of governance over the last 20 years, including on fiscal and debt matters, has ultimately eroded confidence in fiscal management. So Moody's is the sole outlier. They're still rating the US debt at AAA, but it's kind of the next shoe to drop. So what happens on the day that Moody's downgrades the US to AA+? Absolutely nothing. It's one of those things where the short-term effects are negligible, but over the long term, it arguably introduces higher interest rates across the entirety of the market. Credit cards, mortgages, auto loans, the cost of doing business becomes higher, and it's something to watch. Another potential storm cloud on the horizon is the resumption of student loan payments. One of the policy decisions in the early days of the pandemic was to suspend student loan payments. This was protracted again and again, and the Biden administration actually tried to forgive student loans altogether, but the Supreme Court said not so fast, although some still have been forgiven. But effectively, interest rates started accruing again in September, and payments were resumed in October. It's hard to, in terms of magnitude, put a number on what this means, but it could be as high, estimates say, as $200 billion once payments are fully resumed. In simplistic terms, $200 billion to repay student debt is $200 billion not being spent in the economy otherwise. That's close to 1% of GDP. So you can see how that might be a significant or potentially significant drag on economic activity. Furthermore, it may not just be limited to the student loan payments themselves. There's a behavioral response that might rein in spending even more. I have this new debt repayment due. I'm worried about this or that, and you know what? Let's not take a vacation. Let's get another year out of the car. Let's not go and remodel our kitchen. If you multiply all that together, you wind up with a recipe for a downturn in economic activity that, as mentioned at the outset, is really driven by consumer spending. To be clear, I don't think this leads to a reprisal of the 2008-2009 downturn for the simple reason that U.S. households are in a far better economic shape. The statement's somewhat counterintuitive, right? As you'll read in the headlines, with bold type and exclamation marks, consumer debt is at an all-time high, which is absolutely true. Credit card debt is at an all-time high, mortgage debt, all true. But in the same way you wouldn't assess the value of a company only by looking at the debt on the balance sheet, so too with households. It's debt relative to something. The graph shows debt to disposable income. That's all debt. Mortgages, auto loans, student loans, home equity, lines of credit, all possible kinds of debt. The ratio has come down from over 133% in 2008 to 99% today. So it's not a new trend. It's really representative of 15 plus years of deleveraging. On this next chart, I showed debt to household assets, which includes financial assets, so savings accounts, bank accounts, retirement accounts, brokerage accounts. Here, the deleveraging is even more obvious, from 24% 15 years ago to a bit over half today. This is down to a level not seen in over 50 years. Does not mean there won't be an economic downturn. What it does mean is there's a cushion, a shock absorber, if you will, should we see a downturn in consumer spending. And the final thing to watch that I'll touch on today is the futures market implications with respect to the federal funds rate. This is the Fed's primary mechanism, of course, for combating inflation, and they've been quite active, as you can see, based on the chart. The blue bars are historical decisions, interest rate changes that have already happened, while the red bars are the futures market. Not necessarily my expectations, nor BBH's, or even economic consensus, but it's what the futures market implies from a couple days ago. That's when this data was recently updated. The numbers themselves on the slide are not that interesting, and what I really think we should look at is the shape of the curve. So it very much looks like a plateau. So flipping ahead one more page, here you can see I've taken the numbers away, so you just see the shape. So the futures market today in red indicates the rising federal funds rate, kind of plateau before maybe turning downward in Q3, Q4 of next year. That's very different than expectations earlier this year via the futures market. It was more of a bell curve, which you can see in blue. And that's as of the futures market as of March 31, 2023. Again, I invite you to focus on the shape of the curve rather than the numbers themselves. The futures market expectation at the time was the Fed would increase rates rather quickly and then would begin to lower rates after they had successfully defeated inflation. But it hasn't turned out that way, or at least not quite yet. That's the big change in market sentiment, that interest rates, or that high interest rates rather, are likely to stick around for longer. So what to watch out for? I think the economy's at a turning point, and we're going to look back on Q3, and we already are, as a very strong quarter, following which many of these economic tailwinds may subside and may even become headwinds. Of course, I haven't even mentioned some of the sentimental events on the horizon. Terrorist attacks in Israel and now conflict violence throughout Gaza, violence in Ukraine and Russia, US-China relations. These are all things that could have implications from an economic perspective. There's a lot of big picture items out there that in the interest of time, we've not touched on for this presentation, but the good news, I think it is good news for the US economy, is that unlike compared to the last economic cycle and the global financial crisis of 2008-2009, the consumer is in a lot better shape. Leverage is not nearly as high at the household level, which ought to prevent this from becoming a sharp and prolonged downturn. So if I were to look at some of the proverbial elephants in the room, some exogenous risks, and we've not touched on this either, the amount of debt to be refinanced in the commercial real estate market could be a real challenge in the banking sector in particular. Something in the range of $500 billion in commercial mortgage-backed securities will mature and need to be refinanced in the next 12 months. And obviously, based on what we saw with the interest rate environment, these will need to be refinanced to higher interest rates than originally underwritten. And of course, my fifth bullet point, which is really the catch-all, rising political uncertainty that could weigh on market sentiment as well. So covered a lot of data, but with that, I'll conclude. And if you have questions or comments or just simply want to chat, I invite you to introduce yourself, and I'd love to catch up. We can have a coffee or perhaps something stronger at the farewell party this evening. And otherwise, it's been a real pleasure, again, speaking with all of you, and I feel very privileged to be here with each one of you, and thankful for this opportunity. Thank you.